What if I told you that 2026 could be the year that changes everything for your savings, your mortgage, and the global financial markets? The Federal Reserve is signaling something we haven't seen in years: deep interest rate cuts that could send gold soaring, shake the dollar's dominance, and finally bring relief to homebuyers who've been priced out of the market. But here's what Wall Street isn't telling you. These rate cuts aren't happening because the economy is thriving. They're happening because the Fed might not have a choice. In today's video, we're breaking down the Fed's 2026 rate cut strategy, what top officials are saying behind closed doors, and exactly what this means for your money. Stay with me until the end because I'll show you 3 specific moves you need to consider making right now. Let's dive in. First, let's talk about what's actually happening at the Federal Reserve. According to recent statements from Fed officials, we're looking at potential rate cuts of up to 150 basis points throughout 2026. Now, if you're not a finance nerd, let me translate that for you. That's a 1.5% reduction in interest rates. That might not sound like much, but in the world of central banking, this is massive. To put it in perspective, during the pandemic, the Fed slashed rates to near zero. During normal economic adjustments, they typically move in quarter-point increments, 0.25% at a time. A 150 basis point cut suggests the Fed sees something coming that requires aggressive action. But here's where it gets interesting. This isn't just speculation or market chatter. Fed official Kevin Moran has gone on record saying he's specifically looking at 150 basis points of cuts for 2026. When a Federal Reserve official publicly commits to a number like that, it's significant. These folks typically speak in careful, measured tones. They don't throw around projections unless they've got solid reasoning behind them. So what's driving this? 3 main factors. Number 1, economic slowdown signals. The economy is showing signs of cooling faster than anticipated. While we're not in recession territory yet, leading indicators suggest growth is decelerating. The Fed is getting ahead of this curve. Number 2, inflation progress. After years of fighting elevated inflation, the Fed is finally seeing sustained progress toward their 2% target. This gives them the flexibility to shift focus from inflation fighting to supporting economic growth. Number 3, labor market normalization. The job market, while still relatively healthy, is normalizing. We're seeing unemployment tick up slightly, wage growth moderating, and fewer job openings. This tells the Fed they can ease up on the brakes. Now here's the critical question. Is this a controlled, proactive rate-cutting cycle? Or is the Fed being forced into action by deteriorating conditions? Some analysts argue it's the latter, that the Fed will be essentially forced into deep rate cuts to prevent a harder landing, and this distinction matters enormously for how you should position your investments. Let's talk about gold, because this is where things get really interesting for investors. Gold has already hit 1-week highs as markets begin pricing in these Fed rate cuts, but this might just be the beginning. Here's the relationship you need to understand. When interest rates fall, gold typically rises, and it's not magic. There's a logical economic relationship here. Think of it this way. Gold doesn't pay interest or dividends, it just sits there. When interest rates are high, say 5% or 6%, you can earn substantial returns just by keeping your money in a savings account or buying treasury bonds. Gold has to compete with those guaranteed returns, but when rates drop to 3% or 2% or lower, suddenly those safe returns don't look so attractive anymore. Gold becomes relatively more appealing as a store of value. Add to this the fact that rate cuts typically signal economic uncertainty, and uncertainty is gold's best friend. Investors flock to gold as a safe haven when they're worried about the economy, the dollar, or financial stability. Now let's look at the numbers. During the last major rate-cutting cycle from 2007 to 2008, gold rose approximately 25% as the Fed slashed rates to combat the financial crisis. During the 2019-2020 cutting cycle and pandemic response, gold surged over 40%, hitting all-time highs above $2,000 per ounce. If we're entering a new cutting cycle in 2026 with 150 basis points or more in cuts, history suggests gold could see substantial gains. But there's another factor supercharging gold's potential: central bank buying. Central banks around the world, particularly in China, India, and other emerging markets, have been accumulating gold at rates we haven't seen in decades. They're diversifying away from dollar reserves, and Fed rate cuts could accelerate this trend. Some analysts are projecting gold could test $2,500, $2,800, or even $3,000 per ounce if these rate cuts materialize alongside continued geopolitical uncertainty. Now, I'm not here to tell you gold is guaranteed to skyrocket. Nothing in investing is guaranteed, but the setup is undeniably compelling, and it's something you need to have on your radar. Now let's talk about the elephant in the room, the US dollar. The headline that caught everyone's attention was about these rate cuts breaking the dollar. That's dramatic language, but there's real substance behind it. Here's what you need to understand. The dollar's strength on global markets is heavily influenced by U.S. interest rates relative to other countries. When U.S. rates are higher than, say, European or Japanese rates, global investors move their money to the U.S. to capture those higher returns. This creates demand for dollars, which pushes the dollar's value up. But when the Fed starts cutting rates aggressively, especially if other central banks aren't cutting as much, this reverses. The interest rate advantage disappears, demand for dollars weakens, and the dollar's value can decline. A 150 basis point cut would be one of the most aggressive rate cutting cycles in recent memory outside of crisis periods. If the European Central Bank or Bank of England isn't cutting as aggressively, we could see significant dollar weakness. Now, breaking the dollar is probably hyperbolic. The dollar isn't going to zero, and U.S. dollar dominance in global trade isn't ending overnight. But a sustained period of dollar weakness could have major implications. 1. Import prices rise. If you're buying electronics, cars, or anything made overseas, it could get more expensive. 2. International travel becomes pricier. That European vacation or Asian business trip, your dollars won't stretch as far. 3. Emerging market assets become more attractive. A weaker dollar often means better returns from international investments. 4. Inflation risks could resurface. Weaker currency means higher import costs, which can filter through to consumer prices. But here's the flip side that nobody talks about. A weaker dollar actually helps some parts of the U.S. economy. American exporters become more competitive globally. Manufacturing gets a boost. Tourism to the United States increases. The question is whether this is a controlled, manageable dollar decline or a disorderly rout that creates financial instability. The Fed is walking a tightrope here. They want to ease monetary policy to support growth, but they can't let the dollar collapse or inflation resurge. This is the delicate balance that will define 2026's monetary policy. And for individual investors, this means portfolio adjustments are likely necessary, which we'll get to in a moment. Okay, let's talk about what everyone watching this video really wants to know. What does this mean for mortgage rates and home buyers? If you've been sitting on the sidelines waiting for rates to come down, 2026 might finally be your year. Here's the connection. When the Fed cuts rates, they're specifically cutting the federal funds rate. That's the overnight lending rate between banks. Mortgage rates don't directly follow this rate, but they're definitely influenced by it. Mortgage rates are more closely tied to the 10-year Treasury yield, but the Fed's actions influence Treasury yields through expectations, market sentiment, and overall financial conditions. When the Fed signals aggressive rate cuts, it typically pulls down the entire yield curve, including mortgage rates. According to mortgage industry experts, if the Fed follows through with 150 basis points of cuts in 2026, we could see 30-year fixed mortgages potentially dropping from current levels around 6.57% down to the 5 to 5.5% range, 15-year mortgages potentially in the 4 to 4.5% range, adjustable rate mortgages becoming significantly more attractive. Now, before you start celebrating, we need to talk about the housing market reality. Lower mortgage rates are fantastic for affordability, in theory, but they also stimulate demand, and we still have a fundamental housing shortage in most markets. So what happens when rates drop and suddenly millions of sideline buyers jump into the market, all competing for the same limited inventory? Prices could surge, potentially offsetting some or all of the affordability gains from lower rates. This is the paradox homebuyers are facing. That said, experts are suggesting several strategies for positioning yourself. Strategy 1. Get pre-approved now. Even if you're not buying immediately, understand your borrowing capacity and be ready to move when the opportunity arises. Strategy 2. Consider the timing. The first wave of rate cuts might trigger a rush of buyers. Sometimes the best opportunities come mid-cycle when the initial frenzy settles, but rates are still favorable. Strategy 3. Look at adjustable rate mortgages strategically. If you're planning to move or refinance within 5 to 7 years, ARMs could offer significantly better rates in a falling rate environment. Strategy 4. Don't time the market perfectly. If you find the right home at a price you can afford, the difference between 5.5% and 5% over 30 years is less significant than finding the right property. For current homeowners with high-rate mortgages from 2022 or 2023, this could be your refinancing opportunity. Mark your calendar for 2026 and stay in touch with lenders as rates begin dropping. All right, let's bring this all together and talk about what you should actually do with this information. We've covered rate cuts, gold's potential rise, dollar weakness, and mortgage opportunities. Now let's talk portfolio positioning. Here are the key investment considerations for a Fed rate cutting cycle in 2026. First, precious metals. Beyond just gold, consider silver and precious metal mining stocks. These tend to leverage gold price movements. When gold rises 10%, quality mining stocks might rise 15-20% or more. But be selective. Not all gold stocks are created equal. Look for companies with strong balance sheets, low production costs, and growth potential. You can also consider gold ETFs for simpler exposure without the hassle of physical gold storage. Second, real assets. In a weakening dollar environment, real assets often outperform. This includes real estate investment trusts, especially those benefiting from lower financing costs, infrastructure investments, and commodity-related investments. Third, international exposure. A weaker dollar typically means stronger returns from international investments. Consider increasing allocation to emerging market stocks, international developed markets, and foreign currency-denominated bonds. But, and this is important, international investing carries additional risks, including currency fluctuation and geopolitical factors. Fourth, rate-sensitive sectors. Lower rates typically benefit utilities. They carry lots of debt, so lower rates improve profitability. Real estate companies benefit as lower borrowing costs boost margins. And growth stocks, particularly technology companies, see gains as future earnings become more valuable in a lower rate environment. Now, what should you potentially reduce or avoid? Long-duration bonds you currently hold might have already priced in cuts. There's limited upside and potential disappointment if cuts don't materialize. Financial sector stocks, particularly banks, typically suffer in falling rate environments as net interest margins compress, and cash positions earning current high rates will see those yields decline, potentially dramatically. One crucial point I want to emphasize: don't make dramatic portfolio changes based solely on Fed predictions. The Fed's plans can and do change based on economic data. What they're projecting today for 2026 might look different 6 months from now. Maintain a diversified portfolio, make gradual adjustments rather than all or nothing moves, and consider your personal timeline and risk tolerance above all else. If you're near retirement, preservation of capital might matter more than capturing upside from gold or international stocks. If you're young with decades until retirement, you might be more aggressive in positioning for this cycle. Before we wrap up, I want to present the contrarian viewpoint, because good investing requires considering alternative scenarios. What if the rate cuts don't happen as expected? Scenario 1, inflation resurgence. If inflation proves stickier than anticipated, perhaps due to geopolitical events, supply chain disruptions, or wage pressures, the Fed might not be able to cut as aggressively as planned. This would be negative for gold in the short term, positive for the dollar, and disappointing for homebuyers expecting rate relief. Scenario 2, economic strength. What if the economy proves more resilient than expected? Strong growth might keep rates higher for longer. Again, this would challenge the thesis we've outlined. Scenario 3, financial crisis. On the other extreme, if rate cuts are forced by a financial crisis or severe recession, gold might rise, but stocks, even gold stocks, could suffer in the short term as liquidity dries up. The point is, economic forecasting is an imperfect science. The Fed's projections are educated guesses based on current data, but economic conditions evolve. This is why portfolio diversification isn't just a cliche. It's essential protection against scenarios you can't fully predict. Position yourself for the likely scenario, but maintain safeguards for alternative outcomes. All right, let's bring this home with specific action steps you can take right now. Action step 1, review your portfolio allocation. Take an honest look at your current investments. Are you overly concentrated in any single asset class? Do you have any exposure to assets that might benefit from rate cuts? If you're 100% domestic stocks with no precious metals, no international exposure, and no real assets, you might want to consider gradual diversification. Action step 2, assess your debt situation. If you have high interest debt, start planning now. Falling rates could create refinancing opportunities in 2026 for mortgages, but also for other loans. Create a debt inventory and set up rate alerts so you know when refinancing makes sense. Action step 3, build your cash position strategically. This might seem contradictory, given we said cash will earn less in a cutting cycle. But here's the nuance. Having dry powder available to deploy when opportunities arise is valuable. Consider this approach. Keep necessary emergency funds in the highest yield savings accounts you can find. For investment cash you might deploy in the next 12-24 months, consider short duration treasury bills or money market funds. You'll earn decent yields now, and as rates drop, you'll have capital ready to invest in more attractive opportunities. Action step 4, educate yourself on gold and precious metals. If you've never invested in gold, don't suddenly put 30% of your portfolio in it. Start small. Consider allocating 5 to 10% to precious metals through an ETF like GLD or physical gold if you prefer. Learn how it behaves, how it fits in your portfolio, and whether you're comfortable with its volatility. Action step 5. If you're house hunting, get Strategic Connect with a mortgage broker now. Understand current programs, rates, and your qualification status. Monitor rate trends through 2026, but don't let perfect timing prevent you from buying the right home at an acceptable price. Action step 6. Consider professional advice. If your portfolio is substantial or your situation is complex, this might be the time to consult with a fee-only financial advisor who can provide personalized guidance. The shifts we're discussing could have different implications depending on your age, income, tax situation, and goals. Look, here's the bottom line. 2026 is shaping up to be a pivotal year for monetary policy, and by extension, for all of us managing money, making investment decisions, or planning major purchases. The Fed's projected rate cuts create both opportunities and risks. Gold could surge, the dollar could weaken, mortgage rates could finally provide relief to homebuyers, and portfolio positioning might need adjustment. But remember, markets are forward-looking. Much of this may already be priced in. The actual opportunities often come from the deviations from expectations, when reality diverges from projections. Stay informed, stay flexible, stay diversified, and most importantly, don't let macroeconomic predictions completely override your personal financial plan. The best investment strategy is one that helps you sleep at night while making progress toward your specific goals. If you found this video helpful, please hit that like button and subscribe for more financial analysis and investment insights. Drop a comment below. Are you positioning your portfolio for Fed rate cuts? Are you waiting to buy a home? How are you thinking about gold in your investment strategy? I read every comment and I'd love to hear your perspective. And if you want to dive deeper into any of these topics, gold investing, international diversification, or mortgage strategies, let me know and I'll create dedicated videos on those subjects. Thanks for watching, and I'll see you in the next one.